I don't think people understand why their credit gets denied in 2024. Let's dive in. Please remember to like, subscribe, and comment for more Money Smart Basics videos. Stay until the end to receive a bonus tip. If you have any suggestions for financial literacy topics for our next video, please leave a comment. Hey everyone, it's Alfonso, here from Money Smart Basics. Let's be real, getting your credit application denied is a huge bummer. It's like getting rejected for a cool club, except instead of missing out on overpriced drinks, you might be missing out on a car, a house, or even just a decent credit card, and trust me, I've been there. Early on in my real estate career, I had my fair share of applications rejected. It was frustrating, but it taught me a valuable lesson. Knowledge is power. So in this video, we're diving deep into the top 5 reasons why your credit application might be hitting a wall in 2024. We're talking about the stuff they don't teach you in school, the stuff that can make or break your financial future. By the end of this video, you'll be armed with the knowledge you need to navigate the credit game like a pro and boost those approval odds. Let's get started. First up, let's talk about your credit score. This 3-digit number is like your financial GPA. It tells lenders how risky you are to lend money to. Think of it like this: the higher your score, the more confident lenders are that you'll repay your debts on time. A good credit score can open doors to lower interest rates, better loan terms, and even higher credit limits. On the flip side, a low credit score can be a major red flag for lenders. It's like showing up to a job interview in your pajamas. Not a good look. Now, there's no magic number that guarantees approval, but generally speaking, a score above 700 is considered good. Anything below 620 starts to raise eyebrows. And anything below 580 is considered subprime, which means you'll likely face higher interest rates and fewer loan options. So if your credit score needs a boost, don't worry. There are things you can do to improve it. We'll get to those in a bit. But first, let's talk about another major factor that lenders look at: your outstanding debt. We've all been there. You see something you want, maybe it's the latest gadget or that designer handbag, and you think, I'll just put it on my credit card. It's so easy to swipe that card and walk away with your new purchase, feeling satisfied in the moment. But before you know it, those small purchases can add up to a mountain of debt. Each swipe, each small indulgence, slowly builds up until you're faced with a daunting pile of bills. And let me tell you, lenders are very aware of this. They keep a close eye on your spending habits and how they affect your overall financial health. They know that carrying too much debt can be a major red flag, signaling potential financial instability. This can make them hesitant to extend more credit to you. It's like trying to juggle too many balls at once. Eventually, something's gotta give. You might miss a payment or max out a card, leading to even more financial stress. Lenders use a little something called your credit utilization ratio to assess how much of your available credit you're actually using. This ratio is a key factor in determining your credit worthiness. It's calculated by dividing your total credit card balances by your total credit limits. This simple formula can have a big impact on your financial future. For example, if you have a total credit limit of $10,000 and your balances total $5,000, your credit utilization ratio is 50%. This means you're using half of your available credit. Ideally, you want to keep your credit utilization below 30%. This shows lenders that you're managing your credit responsibly and not over-relying on borrowed money. A higher ratio suggests to lenders that you're relying heavily on credit, which can make them think twice about approving you for more. It can also negatively impact your credit score. Now, if you're feeling overwhelmed by debt, don't panic. It's a common situation, and there are steps you can take to regain control. The first step is to acknowledge the situation and commit to taking control of your finances. This means being honest with yourself about your spending habits and making a plan to change them. Remember, you're not alone in this. Millions of people struggle with debt, and there are proven strategies that can help you get back on track. Sharing your experiences with others can also provide support and motivation. One effective approach is the debt snowball method. This method focuses on small victories to build momentum. This involves listing out all your debts from smallest to largest, regardless of interest rates. Seeing your debts laid out can help you understand the full scope of what you owe. Then, you focus on paying down the smallest debt as quickly as possible while making minimum payments on all your other debts. This can give you a sense of accomplishment and keep you motivated. Once the smallest debt is paid off, you take the money you were putting towards it and apply it to the next smallest debt, while still making minimum payments on the rest. This method helps you build momentum as you see your debts disappearing. This creates a snowball effect as you gain momentum and pay off your debts one by one. Each paid-off debt is a step closer to financial freedom. Another popular method is the debt avalanche method, which focuses on paying down the debt with the highest interest rate first. This can save you money on interest charges over time. This approach can save you money on interest charges in the long run, but may take longer to see progress, which can be discouraging for some. However, the financial benefits can be significant. Managing debt can feel overwhelming, but remember, you don't have to do it alone. There are many resources and support systems available to help you. There are resources available to help you navigate the process and find solutions that work for your unique situation. Online tools, financial advisors, and support groups can all provide valuable assistance. A financial advisor can provide personalized guidance and help you create a debt management plan tailored to your financial goals. They can offer strategies that are specifically designed for your circumstances. They can also offer valuable insights on budgeting, saving, and investing. These skills are crucial for maintaining financial health and avoiding future debt. If you're struggling with significant debt, you may want to consider contacting a credit counseling agency. These agencies specialize in helping people manage and reduce their debt. These agencies offer free or low-cost services to help you understand your options, negotiate with creditors, and develop a plan to get out of debt. They can be a lifeline for those feeling overwhelmed. Remember, seeking professional help is a sign of strength, not weakness. It shows that you're taking proactive steps to improve your financial situation. It demonstrates a commitment to taking control of your finances and building a brighter financial future. Setting clear financial goals can help you stay focused and motivated. Now let's move on to another factor that can impact your credit application: recent inquiries. These can also play a significant role in how lenders view your creditworthiness. Alright, let's talk about credit inquiries. Those things that happen when you apply for a credit card, a loan, even when you're trying to rent an apartment. They might seem small, but they can actually have a bigger impact on your credit score than you might think. See, every time you apply for credit, the lender checks your credit report to see how risky you are. This is totally normal, right? They want to make sure you're good for it. But here's the thing, too many inquiries in a short period can make you look like you're desperate for credit. And lenders, they don't like desperate. It makes them nervous. They start to wonder, why does this person need so much credit? Are they about to go on a spending spree? Are they in some kind of financial trouble? The good news is that these inquiries only stay on your credit report for a short time, usually around 2 years. And the impact of each inquiry diminishes over time too. But still, it's something to be mindful of, especially if you're planning a big purchase that requires a credit check. Now, there are actually 2 types of inquiries: hard inquiries and soft inquiries. And it's important to know the difference because they affect your credit score in different ways. Hard inquiries are the ones that can potentially ding your credit. These are the inquiries that happen when you apply for a new credit card, a mortgage, a car loan, things like that. They indicate that you're actively seeking new credit, which can be a red flag for lenders. Soft inquiries, on the other hand, are no big deal. These happen when you check your own credit report, when a potential employer runs a background check, or when a company wants to pre-approve you for a credit card offer. The key difference is that soft inquiries aren't associated with a specific application for new credit, so they don't affect your credit score at all. They're basically just a way for companies to get a glimpse of your credit history without impacting your score. So the next time you see an inquiry on your credit report, don't freak out. Just check to see if it's a hard inquiry or a soft inquiry. If it's soft, you're golden. So how do you minimize the impact of hard inquiries and keep your credit score looking good? Well, the first and most obvious tip is to be mindful of how often you're applying for new credit. Don't just go on a credit card application spree because you're trying to get those sweet sign-up bonuses. Those bonuses aren't worth it if they tank your credit score in the process. Trust me, I've been there. Secondly, when you are shopping around for rates, try to do it within a short period of time, like a 2-week window. This is especially important for mortgages and auto loans. Many credit scoring models recognize that you're just rate shopping and will count multiple inquiries within this time frame as a single inquiry. Pretty neat, right? And finally, always check your credit report regularly. You can get a free copy from each of the 3 major credit bureaus, Experian, Equifax, and TransUnion, every year. Make sure you're reviewing them for any errors or discrepancies, including unauthorized hard inquiries. If you do find any mistakes, don't hesitate to dispute them. Contact the credit bureau and get it sorted out. Correcting errors can significantly improve your credit score, so it's definitely worth the effort. By staying on top of your credit inquiries and understanding how they work, you can keep your credit score healthy and strong. Remember, knowledge is power when it comes to managing your credit. So take control, stay informed, and make smart financial decisions. Your future self will thank you for it. All right, let's talk about employment history and why it matters so much to lenders. It's a topic that often gets overlooked, but it's incredibly important. You see, a stable job is a really strong signal to lenders that you're reliable and you're going to have the income to repay your debts. It's not just about having a job, it's about having a consistent and dependable source of income. It's all about trust and minimizing risk in their eyes. Lenders are in the business of assessing risk, and a stable employment history helps mitigate that risk significantly. When you've been consistently employed, especially in the same field or with the same company for a while, it demonstrates responsibility and commitment. It shows that you can stick with something long-term. It tells them, hey, this person is likely to keep earning a steady paycheck, and that means they're more likely to pay us back on time. This reliability is a key factor in their decision-making process. Think about it from their perspective. They want to minimize their risk and ensure that the money they lend out will be returned with interest. Would you rather lend money to someone who's been in a stable job for a few years or someone who's constantly jumping between jobs every few months? Stability is a sign of reliability. Lenders want to see that steady income stream because it gives them confidence. It reassures them that you have the financial stability to meet your obligations. It's a major factor in their decision-making process, so don't underestimate its importance. A solid employment history can significantly boost your chances of getting approved. Now, I know some of you might be thinking, Alfonso, I've got a gap in my employment history. What does that mean for my chances? Does that mean I'm doomed? Is it a deal breaker? And the answer is, absolutely not. Life happens, right? Everyone has their own unique journey. People take breaks for various reasons. Maybe you went back to school, took time off to raise a family, or maybe you were laid off. It's totally understandable. These are all valid reasons for employment gaps. The key here is to be prepared to explain those gaps honestly and clearly. Transparency is crucial. When you're filling out a credit application, use the space provided to briefly explain the situation. Be concise but clear. Were you focusing on your education? Did you take time to enhance your skills? Did you have family obligations? Be upfront and concise. Lenders appreciate honesty. And if you've got documentation to back it up, even better. It adds credibility to your explanation. The last thing you want to do is try to hide it or make something up. Deception can backfire. Lenders appreciate honesty and transparency, and they're more likely to be understanding if you're upfront with them. They value integrity. Remember, they're looking for reasons to approve you, not deny you. They want to find a way to say yes. Okay, so what if you've switched jobs a bunch of times in a short period? What does that mean for your application? Maybe you're someone who thrives in new environments, or you're on the hunt for that perfect career fit. It's not necessarily a bad thing, that's totally cool, but I get it, it can raise some red flags for lenders. They might wonder about your stability. The key here is to highlight the positive aspects of those job changes. Focus on the benefits. Did you gain new skills or experiences that made you a more valuable candidate? Did you enhance your qualifications? Did you increase your income with each move? Show that your career is progressing. Frame it in a way that showcases your growth and ambition. Make it clear that each move was a step forward. You want to demonstrate that even though you've had multiple jobs, there's a clear trajectory of progress and development. Show a pattern of upward mobility. Again, being upfront and explaining the reasons behind those changes is crucial. Transparency is key. Were you pursuing better opportunities or higher salaries? Make it clear that you were seeking growth. Were you moving up the career ladder? Highlight your achievements, be transparent, and emphasize the positive aspects. Confidence and honesty go a long way in building trust with lenders. All right, we're at the finish line, you're almost there. But here's the thing. You've got to nail this application. A surprising number of credit applications get denied simply because they're incomplete or filled out incorrectly. It seems obvious, right? But you'd be amazed how often this happens. Think of it like this. You wouldn't show up to a job interview with a sloppy resume and missing information, right? It's the same thing here. Lenders need all the necessary information to make an informed decision. They need to see that you're serious, you're organized, and you're paying attention to detail. So take your time. Double, triple check every single detail. Make sure your name, address, social security number, income information, everything is accurate and matches your supporting documents. This is not the time to rush. Now let's talk about some common mistakes people make on credit applications that can lead to those dreaded denials. These are easily avoidable errors that can make a huge difference. First up, inconsistent information. Like I said before, make sure everything matches up perfectly. If your application says you make $5,000 a month but your pay stubs say $4,500, that's a red flag. It raises questions about your honesty and attention to detail. The same goes for your address history. If there are inconsistencies between your application and your credit report, it can create confusion and delays. Another common mistake is forgetting to sign and date the application. It seems like a no-brainer, but you wouldn't believe how many people overlook this crucial step. Remember, an unsigned application is an incomplete application, and that's an easy way to get denied. Here are some pro tips to make sure your application sails through without a hitch. First, gather all your documents beforehand. Have your pay stubs, bank statements, tax returns, and any other relevant financial documents ready to go. This not only saves you time, but also helps ensure accuracy. You're less likely to make mistakes when you have all the information right in front of you. Next, read everything carefully. Don't just skim through the application. Take the time to understand each question and provide complete and accurate answers. If you're unsure about something, don't hesitate to ask for clarification. Call the lender's customer service line, send an email, or visit a branch if you need to. It's better to ask questions and get it right than to guess and risk a denial. There you have it, the top 5 reasons your credit application might be denied, and more importantly, what you can do about it. Remember, knowledge is power, and now you've got the tools to boost your creditworthiness and increase your chances of approval. Don't let a denied credit application hold you back from achieving your financial goals. Be sure to implement the tips we've discussed today. Check your credit report regularly, build a positive credit history, and always read the fine print. And hey, if you found this video helpful, hit that subscribe button and ring the notification bell so you don't miss out on future videos about building a brighter financial future. Until next time, keep hustling and stay financially savvy. Congratulations, you made it to the end of the video. With that, you are ahead of 90% of most people in America. Here's the bonus tip that we promise. You need to hear this if you're a credit seeker. Do you know why your credit apps get denied? Here are the top 5 mistakes you might be making. Missed payments, high balances, too many inquiries, errors on your report, and low credit age. Let's turn that no into a yes. If you have any suggestions for financial literacy topics for our next video, please leave a comment. The information in this video is for educational and entertainment purposes only, and is not intended as financial advice. We are not financial advisors, and the content should not be construed as professional financial advice. Always seek the advice of a qualified financial advisor or other professional regarding your specific financial situation. The use of any information provided in this video is solely at your own risk. Please remember to like, subscribe, and comment for more Money Smart Basics videos.